today, along with us, we have a co-host from ESOP done, Mr. Prasad and Mr. Sheesh. I'll Before we start, I'll just set up the context for the today's webinar. The today's topic is ESOP financing, and in a very simpler words, we'll say it a cashless exercise or a cashless exercising your ESOPs and converting it into equity. So, as an employee, as an organization, what factors and how we can do so, if especially if we are an unlisted entity and like our shares or equity is not openly traded in the open market, right? So, once again, thanks everyone. This side Manish, the business at Vega Equity. Alongside me, I will welcome Mr. Prasad from ESOP Dhan. Mr. Prasad, can you hear me?
Yeah, Manish, yes.
Yeah. Thank you so much, sir, for joining in. I would give a quick round of introduction to our audience and the participants in this webinar. Mr. Prasad comes with a huge and vast experience of more than 25 years in financial markets and capital market industry, working with large organizations, especially in financial markets and with some investment banking firms, right? Having a huge experience in fund managements and capital markets and family offices functions, right? Thank you, Mr. Prasad, once again for giving your time and being available uh, in the weekday at 3 p.m. I know you are very busy and taking out time from your busy schedule. It's something it is very important for us. Once again, thanks a lot. And
Thank you, Manish.
as our participants are there, I'll have set the context once again. I'll quickly tell each and every one of our audience and the participants. We are focusing today. This is a series of webinar. This is our seventh webinar in the ESOP series, wherein in many previous series we have covered in detail what ESOP is, how to read and accept the grant letters, how to avail ESOP liquidation benefit if you are unlisted entities, what to see if you are accepting ESOP from the organization at different stage and different type of organizations. As an employee, what are our do's and don'ts as a decision makers and as a part of the management and the functional body? What are the things to factor in and to analyze while deciding or launching a new ESOP scheme designs, right? So in the same line, in the same context, today we are discussing on ESOP financing model. And to be very crisping it will tell you and help you understand how as an employee, as employee of an unlisted entity having holding ESOPs from our organization, the time when it comes to exercise and when your vesting completes, what are the factors and how you can decide whether it is the right time for me to exercise. And if you decide to do so, what will be the cash flow and what will be the avenues wherein you can easily exercise the maximum quantity and the quantities whatever you deem fit before even worrying about the financing and the cash flow problems, correct? So thank you, Mr. Prasad. I hand over this to you. And before we start, I'll just set the full agenda here. We are starting with on a detailed discussion on the ESOP financing and various avenues possible. We also will have a detailed Q&A session, right, in the end after 3:50 or 3 sorry after 3:40 p.m. we'll be having a detailed specific Q&A session wherein we will be taking questions from the audience, from the people who have any questions regarding the topic and any other things from the ESOP part, right? And in the first 30-35 minutes, we'll try to cover and provide the maximum inputs or insights from this area. Over to you, Mr. Prasad. Once again, thanks for joining.
Yeah, thank you, Manish. Thanks for the introduction. And a warm welcome to all the joinees. So let us just, thanks, Manish already gave the background of topic what you're going to talking today. So let me just put up my screen and we'll go through one by one. So before we are coming into our core subject, we would like to just refresh certain terms so that it is going forward the discussion. This will help you to understand the clear context of what are we trying to explain you on the early exercise of ESOPs and things like that. So here, the first thing on any ESOP, the ESOP start with the company formulating an ESOP policy. Once the company's ESOP policy is in place, it will issue the grant letter to the employees.
Right.
So when the grant letter, the content of the grant letter, basically, I'm just giving the certain key terms which are relevant for our today's discussion. So the grant letter will have a date when the grant letter been issued. The grant letter will contain what are the total number of options granted to each employees. So this grant letter been issued to each employee who are beneficiaries of the ESOP program of the particular company. So the total number of options, then the exercise price, at what price the company is granting you the option, which is the exercise price. Then it will also have a vesting schedule. So usually assume a person is getting say 15,000 options. The 15,000 option will not get vested in the initial time. It will have a vesting schedule or a different vesting date. For example, they may say 1/3 of it, say 5,000 option will get vested on completion of say year one, and maybe the remaining 5,000 in year two, like that. So the vesting will happen over a period of time. So this vesting date, when the on a particular date the shares will get vested, that is the time an employee is eligible to exercise the ESOP. So that vesting date is an important context for our discussion today. Then the next is the exercise of the assume there is a vesting is an X date, and within an n number of years, depends on company to company, they may put a lapse option. That means if you are not exercising the ESOP within say 5 years, 6 years, 10 years, depends on the company's policies. If you don't exercise the ESOP, it will get lapsed. Then you will no more be eligible to exercise the ESOP. Then the other option when the ESOPs will get lapsed is assume you are discontinuing the employment with a particular company, the company whom where you are beneficiary of the ESOP. So usually when an employee is discontinuing the employment, then that point in time, they may have a limited window to exercise. Usually it may be 60 days, 90 days. If you don't exercise on your discontinuation of employment within the specified number of days, then you will no more be eligible to exercise these ESOPs. So which is the lapse at the termination of the employment.
Sir, Mr. Prasad, sir, I would just request you if you can reshare the screen. Their screen is a little bit of a blurry on top, like we cannot see the heading. Right. If you can please reshare, I
Okay,
would request you.
sure. Is it okay now?
It is. Let us reshare if you allow. Let me share it. There is some blurriness that is coming, so we are not able to see the complete screen.
Okay.
Yeah, it is.
Sorry.
Yeah,
Is it okay now?
let us share it, and it is coming perfect now. It is coming perfect now. We can continue.
Okay, done. Perfect.
Yeah.
So the other important point what one should understand is the fair market value of the share of the company. So usually when an employee is exercising the ESOPs at the point of exercise, the fair market value is an important factor. The fair market value is the say when we talk about the price per share, this is the price at which the company will be issuing its shares to the third parties or the investors. So the fair market value of a company will keep growing as and when the new round of funding happens. You know, all these unlisted private companies, which will all be growing companies, as and when the company's growth stage keep happening, they will have different stages of fundraise will happen, say Series A, Series B, Series D, so like that. And each time the new funding round happens, usually the fair market value of the or the share price of the company will keep growing. So this is an important, again, an important element for us to understand the tax impact on the at the time of exercise. So for just to give an example, like we can just take a case example of, I will just share. This may be a case study of Zomato being a company which is a startup, grown over a period of time. Then it is got listed at some point in time. So if you can see my screen, just to for you to understand the concept of fair market value, when Zomato issued its Series A in the Series A fundraise, which happened in 2012, at that point in time, the effective share price was basically 45 paise per share. It is. So then, as and when the funding round happens, the share price keep growing. And when they reached the IPO in 2021, the the 45 paise of the per share grown to 76 rupees, which is the IPO price. So you can see in this example from the Series A funding round, the fair market value of the share grown around 168 times. So just to get a concept of the fair market value.
Yeah.
Okay, so now let us understand at the time of your an employee is exercising the shares, there are two type of cash flow requirement is there. One, whatever the number of shares you are exercising, you have to pay the company the total number of share options into the exercise price. So that is the amount to be paid to the company. Then there is a tax incident at the time of exercise of the shares. Okay, Manish, would you like to cover anything more specific on these terms, what I
Yes,
explained?
I'll take it once you finish this slide, and I'll just engage our audience as well if they have something in their mind.
Correct.
So, thank you, sir, in explaining all those basic concepts and basic terminologies for our audience to understand much in detail as we go ahead in this webinar. So, in to conclude all the summary right now, whenever we receive ESOP from our organization, in the grant letter there are multiple terms and clauses and units are mentioned, or the various parameters are mentioned. So as a new person, when we are receiving ESOP for the very first time, we do not understand the relevance and the importance of each and every item, right? So that is why we were taking this in detail, okay, what all does that mean and how you have to evaluate, right? And going forward, like as you tell, like when we are going ahead in this, there are a cash outflows, which was the concept of this webinar, right? So when ESOPs are granted to us, it's an option, right? But when the vesting gets completed, we become we contain the right to exercise and convert it into equity share by paying either exercise price. If in my grant letter it is mentioned like a share of 100 rupees is given to me at 10 rupees or 5 rupees, then I have to pay 5 rupees per share or per ESOP to my company at the time of exercise, which is the exercise price payable to company. And when I exercise, the difference between the fair market value on the date of exercise and my exercise price is being charged as my income from salaries, right? Because I am receiving a share from my company, for example from Zomato, which market price is 140 rupees, but I am paying only 5 rupees to Zomato to exercise that share. So the difference, which is 135 rupees, that is my perquisite income, on which a perquisite tax will be applicable, and I have to pay it on my income tax rates, right? So this is the first cash outflow as an employee when we try to exercise our ESOPs, right? Yes, Mr. Prasad, we can continue and take this ahead.
Sure. Okay, thank you. Because now let us understand what is the tax computation at the time of exercise. There are two tax incident to anybody in an ESOP exercise time. So there is a first tax happens when we are exercising the ESOPs. So at that point in time, as I explained, there is a concept of fair market value, which is the at the time of exercise, what is the prevailing share price of the company, which is the fair market value of the FMV score. So the difference between the fair market value and the exercise price is being taxed as the perquisite value of the ESOP, which is as good as a salary income. So that is the first tax incident, which is taxed at the gross tax rate. So if you see the gross tax rate, the progressive tax rate different based on your income slab. So the highest tax rate, I am taking the highest tax rate for the purpose of discussion here. The highest tax rate with the surcharge and the cess and all is coming to 39%. So the difference between the fair market value and the exercise price will get taxed at the rate of 39% at the time of exercise of these ESOPs. That is the first tax incident happens on the ESOP exercise basically. The next tax incident will happen when you are liquidating the share or when you are selling the share. So when the sale happens at that point in time, whatever the fair market value at the time of exercise will become your cost in the hands of the employee, and the difference between the sales price and the exercise fair market value will become taxable in the hands of the employee as a capital gain tax. So there's a difference between the perquisite value tax and the capital gain tax. So on a perquisite or a normal salary income, the highest tax rate is 39%. And when the capital gain tax, it is going to be based on the last budget, the latest budget. The highest capital gain on a long-term capital gain is 14.95%. So there are this again in case of the long term and short term is also it is important to understand. So if the sale happening the post listing, that means the company in which you are holding the shares is getting publicly listed and is becoming a listed company. If you sell post listing, then if you are holding the shares for more than 12 months, which will become qualify as a long-term capital gain, will be taxed at the rate of 12.5 plus applicable surcharge and cess. And if it's a short term, if you are holding less than 12 months, then it is 20%. If you are selling it at pre-listing, then the long term will still get in case of pre-listing, the long term will be qualifying as a 24 months of holding. That will get taxed at 12.5%, and the short term will tax at the regular tax rate. So this is just a tax rate difference. Now let us understand where is the catch, what we are trying to explain on the benefit when an employee is exercising as early as possible. So as I
Mr.
explained,
Mr. Prasad,
yes,
just for our audience, meantime they consume the information from the screen.
yeah,
I just add here like why this decision is very important, ki when to exercise and how much to exercise. Because as a ESOP holder or the recipient of option, we need to understand maybe currently we are holding ESOP worth rupees 1 CR or 10 lakh or 30 lakh, right? But whenever our company asks us to exercise or give us an option to exercise, again I'm telling exercise means you are converting your ESOPs into equity share of the company. So it is ultimately our own asset, so we have to decide when and how much we will be exercising, right? But other than this, there is an important factor as well which we as an employer, which we as a ESOP holder need to know. Okay, if we are exercising today and how much we are exercising, so what will be my cash outflow versus if I exercise a year later or 2 year later, and if I change the quantity to exercise basis my cash outflow or cash availability, right? What will be the impact on me, right? So on the coming uh, slide or maybe the coming information, Mr. Prasad will be briefing us, right? As a user, as a ESOP holder, as a beneficiary, what are the key factors we should calculate or we should keep in our mind before deciding the timing and the number in the count, right? And how it can be provide us maximum saving. Yes, sir, over to you.
yes, thank you. Okay, so in this case, when, as we discussed in the first slide, when the vesting of the ESOP happens, then it is in the hands of the employee to decide what time to exercise the ESOPs. So as I explained to you in the previous slide, the tax in the first tax incident, that is the tax at the time of exercise, which is a mathematics of the difference between the fair market value and the exercise price. So what happens as the fair market value of the company will keep growing over a period of time, it is negative for an employee when one is exercising when the company is nearing to the IPO. Say, for example, when the vesting of the share happened, assume, say, the fair market value of the company was, say, 50 rupees, which will keep growing, say, assume the IPO happening, say, at 500 rupees. So what are we trying to explain here is when we exercise, assume the vesting happened and the fair market value of the company was 50 rupees, and assuming, say, 30,000 is the number of options you are holding, the exercise price is 10 rupees. So if you exercise when the fair market value of the company is at 50, then you will be paying a tax, a difference between 50 and 10, which is, say, 40 rupees into, say, 30,000 number of shares into 39%. So which is the first tax incident happened in the employee's hand. That means he exercised, and in this example, the tax amount will come to 4,68,000 rupees. Then assume the company exercised the employee exercised the options and continue to hold the share. Assume the listing happening, say, next 3 or 4 years. When the listing happens, the company's price is going, say, 500 rupees. So then at the time of sale of the shares at, say, 500, then the difference between the 500 and the fair market value at the time of exercise, which is 50 rupees, that 450 rupees, you will be paying tax only at the rate of 14.95%. So in the example, I am assuming the highest tax rate. So depends on your tax slab, you may be in a different tax slab. So on just an illustration, I am using the highest tax rate. So in the instance, you exercise the shares when it was vested and the fair market value was at 50, your total tax incident, including the tax what you paid at the time of sale of the share, which is 20,18,250 in this example. So your total tax you would have paid is 24,86,250, which is the combined of the tax at the time of exercise and the tax at the time of exit. Now let us compare the same situation. One employee is not exercising his vested shares when the fair market value of the company was, say, 50. And he was waiting to see the IPO happening, and now the employee is coming and saying, okay, now the IPO is nearing, so let me exercise the ESOPs. Then what will happen by the time the fair market value of the company is only reached 500? So since he has not exercised earlier, the difference between 500 and the exercise price of 10, that 450 rupees will get taxed at the rate of 39%. So then the tax amount in the same example is going to be 57 lakh 33,000 rupees. Now you see what is the advantage. One employee who exercised when the vesting happened and one who is not exercising the vesting and waited till the IPO, the difference in the tax is 32 lakh 46,000. So this is what is the key point for an employee to understand. There is a decent amount of tax arbitrage when an employee is exercising the shares when the share price of the company is in a lower side or the fair market value is in a lower side. So Manish, would you like to add anything on this particular point?
Yes, so it generally, as very well explained by Mr. Prasad sir, right? So as an employee, we are associated with the organization from a time, maybe 1 or 2 or 5 year, right? So we know, and we deep inside we know like how the organization is going ahead, what are their IPO plans, and maybe how the organization is performing. And we also know the value of the stock options of the ESOPs we are holding, right? So it's a plain mathematics or a calculation anyone can do on their Excel or on their laptop, right? Okay, I am holding this many number of options today, right? I am sitting at a 20% or a 30% tax slab, right? So this is my FMV, this was my exercise price. So what will be the liability if I exercise today? And basis the previous increases in my price from the seed round to series A, B, or C, whatever it round we are currently, right? So how we would be paying taxes, or what will be our cash outflow if we go and hold after 2 or 3 years more, right? So what will be the possible outflows? So everyone today keeps on calculating. So the whole purpose of explaining this to you or keeping this session for all of our audience is like, we all know like we are holding ESOP worth rupees say 10 lakh or 1 CR or 50 lakh, but how we can take home the maximum out of it, whether we are taking only 60% at home, or whether we are able to take 75 to 70 or 80 or 85 percentage at home, right? So how we can maximize our cash inflow, all right, by minimizing the cash outflow at the time of exercise and at the time of selling the shares, right? So the quantum and the actual numbers can be different for every different individual with different organization with holding different number of stocks. But ultimately, even if I am holding ESOPs worth rupees 10,000, still I have a arbitrage whether I am taking home net inflow at 7,000 rupees or 8,000 rupees, or even if you are holding at 10 lakh or 50 lakh. So you can calculate whether you will be taking 8 lakh or 40 lakh at home, or you will be taking just 6 lakh or 30 lakhs at home. So we'll be sharing more insights like how you can just do those calculation, how you can evaluate what will be the right timing, what will be the right factors for you to decide. It's over to you, sir.
Okay, thank you. Okay, so in this example, assume you exercising the ESOP when the price was 50. Your the tax incident what you have to pay upfront to the company in the first case is 4,68,000 rupees. And in the second case, the tax one has to pay upfront to the company. It is a TDS, so you'll be paying to the company and company paying the tax to the government. That is the system in this case. So in the second incident, you will be paying 57 lakhs 33 is the tax obligation on an employee to pay. There are certain statutory support which is available under the Income Tax Act. It is important for me to mention that also here. If you are an employee of a startup company, there is a Government of India startup program. It's called the DPIIT. So if a company is a recognized or a eligible startup, there is an exemption for the employees of the eligible startup. So in case of the employees of the eligible startup, there is a deferment option available, which is important for you to understand. And you should ideally check with your company at the time of exercise whether the company is an eligible startup or not. If it is an eligible startup, there is a deferment. The TDS can be paid within next 5-year period. Or it is all linked to, there are three incident is the tax payment obligation for the employees of the eligible startup. One, completion of the 5-year window, or the employee is selling the exercise shares, then the tax will be payable at the point of sale. Or if the employee is leaving the organization, at the time of the employment is getting terminated, that point in time, whatever the TDS was payable, tax was payable at the time of exercise, the employee will be forced to pay the full amount at the time of termination of the employment. So this is available only to the employees of a eligible startup company, which is a defined term in the Income Tax under 80 IAC. So this is also an important information for you to understand. So you should definitely check with your company whether having that eligibility. But again, one important point to keep here in mind, for any reason, any instance, if you are availing that benefit and eligibility, but if you discontinue the employment with the company at any point in time, then you will be liable to pay the tax upfront at the time of termination of your employment with the company. So that again, that tax liability can come back to you. So this is basically giving the input inside of the thing basically. Okay, so now let us just conclude what we are trying to understand here. Okay, so from all this example, there is clearly a tax arbitrage in case of when it is a decent amount of tax arbitrage or a lower amount of tax obligation if an employee is exercising the ESOPs when the company's share price in a lower side. So that is as early as you are exercising as low as the tax you'll be paying. That is the advantage of the early exercise. Then there is one more important point to understand. If you notice, many of these growing companies will be keep coming up with the ESOP liquidity programs. That means the company will offer that the company will buy back the ESOPs from the employees. So in that case as well, so now it is important to understand the long-term, short-term capital gain concept. If for an unlisted company, the shares will get qualified as a long-term capital, eligible for long-term capital gain tax if an employee is holding the shares for more than 24 months. So if it's an unlisted company shares, if you are holding for less than 24 months, then you will again end up paying the tax at the gross tax rate. So assume there is an ESOP liquidity program coming from the company. It is not a buyback actually, even though it is called as a buyback. It is actually a secondary transaction where the promoters or the investors will be buying the shares from the employee and giving the liquidity to the employee. So this is being a secondary transaction. This will also be a disadvantage for you if you are not exercising on the right time and waiting for the IPO to happen. So that time also is a disadvantage. Now, one more important point, assume you are exercising at the time of IPO. So it's nearing the IPO when you exercises, there also a holding period concept will come into. Assume you are going to sell the shares on a post listing, then the 12 months is the minimum holding period to eligible for the long-term capital gain on a lower amount of tax. So there also it will be a disadvantage for an employee for not exercising in the appropriate time. So in short, there are multiple instances where the lower amount of tax can trigger if an employee is exercising the ESOP in the appropriate time and when the fair market value of the company is in the lower side. So this is in short, the benefit for an employee to exercising the ESOP in the right time. Manish, would you like to add anything on this concept?
Good to go, sir. Here, I think
Okay,
we
perfect.
can.
Okay. Now let us try to, so assume then we all understood that there is an advantage of a tax arbitrage for one to exercise the shares in the right time. Now the issue will come into an employee's mind is basically, how am I going to fund my cash requirement? That means at the time of exercise, I have to pay certain amount to the company, which is the number of shares into the exercise price, which I have to pay to the company. So I need a cash for that. Second, the tax payment obligation, which is again payable at the time of exercise, subject to that startup point I mentioned. So there are two type of cash flow you need. So the employee's question will come in, how am I going to get the cash to meet my exercise funding obligation? Let us evaluate certain funding options what we are going to introduce you. So in ESOP Dhan is a registered NBFC. Here we are come up with we are trying to solve the issue of the funding issue at the time of exercise of the ESOPs. So there is a loan designed specifically for the ESOP exercise for the unlisted companies. So these are the loan features basically. So if at the time of the funding requirement, if you have your own source of cash, obviously well and good, you can use that cash and go ahead and exercise your ESOPs. Now, if you need to find other funding options, what we are trying to offer is a tele-made funding option for the purpose of ESOPs. So usually an employee will go for a new loan. What is the first thing will come into his mind will be, if I take an additional loan, I have to pay the EMI. There is a monthly servicing of the loan, interest or principal and whatever it comes in. So we are trying to design a loan product which is cash neutral to the employee and there is zero cash contribution required to be contributed by the employee. So we will fund the amount required for the amount to be paid to the company for the exercise price and the tax incident, whatever the tax obligation to be paid to the company by the TDS, the tax amount. Only caveat here is we will be capping the maximum loan at 35% of the total value of the shares. So there are three key features of the loan product. One, we are saying there is no EMI. When I disburse you the loan, what is the amount required for the tax and the exercise price? There is no EMI applicable on that. The full loan and the applicable cost is repayable only at the time when the ESOP shares getting liquidated or a liquidity event happens. Liquidity event can be you are selling the shares in the time of IPO, or the company is offering you a buyback in between, anything like that. So the full loan amount along with the cost is repayable only at the time when a liquidity event happening. So there is no cash outflow from the pocket of the employee for the purpose of exercising these ESOPs, which is then very important point. So there is no cash flow impact on your monthly, net take home salary basically. The second point, in this case, what the loan we are offering, we are not taking any additional collateral or any additional security other than the shares what you are holding from the company, what you exercised using the ESOP proceeds. So the only security for this is the unlisted shares of that company where you are employed with. That shares is the only security. Your house or your car or nothing is, no other physical asset is getting attached as a. So for any incident, there is no fear of attachment or there is no personal guarantee, nothing like that. The only security is the collateral shares. Third and the most important point. So this is very, very typical offering what we are giving here. For any reason, the one other fear factor in the mind of employee for not exercising the ESOP at the right time is basically assume I am paying my pocket the exercise price and the tax amount for any reason. Assume this company is not doing well and the share price is going down, or on a worst case situation, assume there is a the company is getting liquidated or the company is getting wound up. So in that point in time, what will happen? The value of the underlying shares will become zero. So what we are telling here, if any such incident happen, the price of the share of the company going down or it is going to zero, then the loan repayable is only whatever the amount recoverable from the shares is the only obligation to repay the loan. Assume, say, you taken a loan of 50 lakhs rupees based on the then prevailing fair market value and the share price of the company gone down. And the total amount was, say, it is the share total value of recoverable, say, only 5 lakh rupees. Then in that point in time, the 45 lakhs rupees, the difference will be absorbed by us being ESOP done, and there is no obligation from the employee to repay that loan. So these three are the most important point which will eliminate the fear factor from the mind of the employee and will encourage employees to go and exercise the ESOP by taking the loan from ESOP then and going ahead and exercise the shares, and whereby you are getting a decent amount of tax arbitrage. So then coming to the cost of the loan, obviously we are on NBFC and the cost of this loan is linked to the growth of the share price, basically how the fair market value of the underlying shares is growing, the cost is linked to that. So we can, once we engage any interested people, we can come into a detailed, conversation on that and we can explain it further. Before coming to the Vega offerings, I'll just conclude here. Okay, so other than in today's time, if you see what are the options available to an employee for sourcing the fund to pay the tax and the exercise price. Either if you're having an own source of fund, well and good, no need to have a secondary, any other option. And assume there is no money available, then assume you are going to go for a personal loan. So this is the one immediate question comes to an employee's mind, the personal loan is an option. But what are the disadvantages of a personal loan in this situation? In a personal loan, definitely there is an EMI. So from your take-home salary on a monthly basis, you have to pay the loan, the EMI to the bank or NBFC, wherever it is. So there's a it's an impact on your monthly the available cash basically. Then there is assume any underlying, so then again there will be an additional collateral, correct? The no bank will give you an unlimited personal loan unsecured. Then the bank may tell you to give your more collateral of the house or land or whatever it is. So that is the secondary thing. And for any default happens, there is a risk of the underlying property getting attached or liquidated. So then, and also in case of a personal loan or any loan from banks and all or NBFCs, so there is a CIBIL score issue. You are defaulting in the EMI or you are not paying the loan repayment on time. This all will impact your CIBIL score. And you all are aware in today's time, CIBIL score is an important factor when you go for taking any type of loan. Even if you're today going for a housing loan, the CIBIL score is being evaluated, and if a score is below a specific level, then the bank will not give you the loan. So what are we trying to offer? These all key features, the loan what is designed for the purpose of ESOP exercise. By taking this opportunity, one should think that I should exercise my vested ESOP at the appropriate time and make the benefit of the tax arbitrage, and which will help an employee to create more wealth for himself. That's it. Thank you. And Manish, you can take it forward and you can touch upon the Vega offerings as forward.
Yeah, thank you so much for explaining very beautifully. And I hope the biggest doubt in the today's world in the employee's mind is on the cash outflow. And the top trending question in ESOP world, in the employee's world, is why should we and I exercise when my company is unlisted, when my company cannot provide me liquidity upfront? Why should I pay out of my savings and personal, maybe mutual funds or FDs, whatever I have saved for my future investments and all? Why should I break that and pay upfront when I am not getting any liquidity, right? Though now, as more and more awareness programs, sessions, and trainings are available, right, for the employees in the organizations, people are aware early exercising will mean saving a lot of tax arbitrage if we go public, if the FMVs keep on increasing. But still they struggle to know how and from where they get the, and why should they pay upfront their hardcore savings, right? But with this solution, what we are talking about, right, when the ESOP financing is available without any upfront EMIs, without any collateral, by giving you a safeguard, even if the companies go bankrupt or the valuation goes down, we need not to pay back, right? So with these kind of securities and possibilities, we do not have a single reason in the employees world and the ESOP holders world why we should not go and start thinking of early exercising and converting our ESOPs into equity, right? Whether the liquidity is available upfront or not. So thank you, Mr. Prasad, once again. On the other side, as at Vega Equity, I'll just quickly say, like, we are a digital end-to-end ESOP and a cap table management platform which help organization, employer, employee, and different stakeholders from different functions to effectively and streamliningly managing their day-to-day administration and digital grant vesting and everything without a single manual or a man efforts or doing any manual calculations, right? Sir, we have something to share here. I would request if you can stop sharing your screen, and then
Yeah.
we are directly jumping onto the Q&A sessions.
Yeah. Before just completing this, I would like to give a disclaimer here. So we are not a tax advisor basically. So whatever we illustrated here is based on the highest tax rate. One should definitely evaluate your own tax liability based on what is your income slab and accordingly. So thank you very much for all participants, and if any Q&A, we can continue to that.
So we are moving ahead for the Q&A session in next 2 minutes. Before that, we have something to share here. Thank you once again, audience. Just wait for another 2 minutes. We are starting our Q&A session wherein we will be answering major of the doubts here. Sunny, if you can share the screen. This is a part of our environment and go green and saving the mother earth, a plantation drive which we have initiated recently. At every webinar end, we plant one tree in the name of our co-host and the partners. So we are honored to give this one plantation at Sundarban Tiger Reserve in the name of Mr. Prasad Nair, which is a small token of appreciation from Vega Equities team. And with every webinar, we keep on adding one new plant in the environment, which will definitely help keeping the environment safe and more green for our future generations to come. Thank you, Mr. Prasad.
Yeah, thank you,
Whenever
Manish.
you visit Sundarban Tiger Reserve for the next time, you will find one tree in your name.
Oh, wonderful. This is a very, like a noble cause basically for the Mother Nature. Very good initiative taken by Vega. Thank you very much.
And we are having that privilege to plant more than 10 trees over the last 5 months,
Oh,
and we'll
perfect.
keep on
Wonderful.
adding more and more there. So now we are switching to the Q&A session, which is most of the audience was waiting for that. Though maybe this concept was new, maybe most of us were listening to the word ESOP financing, or whether ESOP kind of a loan are available in the open market for the very first time. So definitely there will be a lot of Q&As or maybe a lot of confusion which can arise by listening to this for first time. I'll give my example as well. I am into this ESOPs end-to-end designing, end-to-end management, digital administration from last 6 or 7 years. But the day when I heard the ESOP financing for the very first time, I still had at least 50 queries, which I keep on asking Mr. Prasad every now and then. Okay, what will happen if that happens, and what will happen if that happens, right? So again, in a nutshell, ESOP financing, just like you take personal loan from the banks for your some of the personal works, maybe for the education, maybe for the marriage, maybe for some of the other purposes, right? Similarly, we are providing ESOP loan or ESOP financing to employees who want to exercise and have a liability of say 5 lakh, 50 lakh, 40 lakh in terms of taxes and all. We provide that we provide that cash outflow upfront to the employee, who do not need to pay any single EMI till you liquidate and till you make your own money. So tomorrow when you liquidate it for 1 CR or say 50 lakh, you will pay out of what was the ESOP financing amount you have taken now, right? In a very nutshell. Now, starting with the questions, we have the very first question during the session was, what are the legal and regulatory consideration for ESOP financing from the company point of view as well? Like if I am an employee of a company and we want to avail this ESOP financing, so is there any regulation or the consideration which I or my company need to take care before we start entering into this kind of arrangement?
Sure, good question. And this is usually the concern from the employer side, basically. So this, let me put it very clear. Here, the funding what we are giving to the employee, it is the loan agreement is between the employee and ESOP Dhan. So we being the lender and the employee being the borrower. There is no liability whatsoever on the company side at all. The company is not involved in the loan agreement or the pledge agreement. The only limited role of the company is the creation of lien on the shares. Assume, say, you are subscribing, say, 10,000 shares from the company and we are funding it. Those 10,000 shares will be creating a pledge with us. That is the only obligation of the company. There is no financial obligation whatsoever on the company side. It is a pure contract between the lender and the borrower being an employee.
So does
Thank
this
you.
come under secured financing then? So are shares offered as a collateral or something like that?
No, see, this is the security is only limited to the underlying shares. The shares also can act as a
Correct.
security, correct? Even though
That's
it
what
is
I'm saying.
a,
Yeah.
so it's a very good question.
Hmm.
Again, if it is, since this being an unlisted company share, if you go to a bank or any large
Not
NBFCs,
marketable.
nobody
Hmm.
will accept this as a security. So here we are accepting this as a security. So that is what is the beauty of it actually. So there is no other security coming in this.
Hmm.
Yeah.
Right. Can we move ahead? So the next question was on the process, right? If my organization and some of my ESOP holders wishes to start this process, like we want to avail ESOP financing because, for example, I have certain corpus which will be required if my employees start exercising, say 5 CR or 10 CR. So what is the process and what will be the steps as a organization, and right what we need to do other than entering into an agreement and a mutual transactionary agreement, what all we need to perform to start this service from there.
Okay, so we usually prefer the go-to-market concept is going to the company and explaining the company that this is a product available. And at the end of the day, we are very clear from that tax arbitrage concept. There is a clear wealth creation opportunity for the employees and without any cost from the company. So we should usually prefer the company to promote this product as an employee welfare scheme through the HR of the company. So we once we identify a company and onboarding the company as a eligible company for the employees for the ESOP product, then we will usually call all the employees into one meeting or something and then explain the features and then go ahead. So it is usually we prefer that being promoted by the company as a employee privilege program sort of.
Thank you.
Yeah.
The next is like if I avail financing from ESOP then, and if I avail ESOP financing and you are a NBFC, right? So you must be reporting to RBI for certain factors.
Correct.
So will it have any impact, positive or negative, on my CIBIL report as well if I avail the financing?
Okay, so this is again a very common fear factor from the employee side. So if you understand the CIBIL score, how it works, since we are being an NBFC, we understand that now. See, all the NBFCs and the banks has to report, to the RBI through a monthly reporting. What are the loan disbursed with the complete KYC information of the borrower. And in the event any of the employee or any of the borrower is making a default, it is the obligation of the institution, the bank or the NBFC, to report that as a default. So only when the lender is reporting an employee or a borrower as a defaulter, that is a point when the score will get impacted. So in this case, since our contractual obligation is that, assume the company price is going to zero, then our contractual obligation is the employee is not liable to repay the loan. So then we will write off the loan. Then we being an NBFC, we cannot report that loan as a default. So till the time we are not reporting the loan as a default, then it will not impact the CIBIL score at all.
Right. Thank you. Another is a very recent question as well, right? We have a recent budget announced last week, right? So, what are the impacts of the recent budget on the ESOP taxation and its impact on the employee and the companies, right? So, one thing before you start, I would there's a clear difference that LTCGs or the long-term capital gain taxes have been increased from 10 to 12.5% right now for listed entities as well, and on the other hand, it has reduced from 20 to 12.5 for the unlisted as well, right? There is one change in that sense, and Mr. Prasad, if you would like to add more here, right?
No, I think there is no specific impact, from this budget on the ESOP perspective because the perquisite tax will remain as per
Yeah.
the gross tax rate. The only point to note is basically now for a listed company, the listed shares basically, the holding period is 12 months, which was the case in the past as well, and the unlisted it is 24 months. So the 12 months and 24 months will remain as it is. The only thing is even the unlisted shares, earlier it was taxed at 20%. As per this new budget notification, the long-term capital gain on unlisted shares also coming down from 20 to 12.5%. So this is actually a beneficial point for the employees of a foreign company. Assume there is an Indian resident employee who is a employee through a subsidiary in India, then he is holding the foreign company shares as ESOPs. Those employees will get benefit and reduce the tax from 20 to 12.5%. Otherwise, there is no specific impact on any perquisite tax or anything like that.
Absolutely. Another thing is like people still want to understand, right? I, along with my 50 other colleagues or employees, holds ESOP whose value may be approximately say 50 to 60 CR today. And if we exercise all our due invested ESOPs, we have to cumulatively pay say approximately 5 to 10 CR of the amount in form of taxes and excise price money to the company. So if we wish to avail this facility as a group of our individual from an employee side? Does it require involvement from the board or the management side as well, or we can go ahead and take direct availability of this financing from you?
Okay, so I'm not 100% sure about it because the end of the day, the ESOP tax liability is not cannot be clubbed together by many employees, correct? It is an individual obligation of each employee. If you're talking about the ESOP trust or something, assume the company is forming an ESOP trust and the ESOP trust will become the holder. So we need to really see that part. If the ESOP being exercised through the ESOP trust, I think it may be a documentational issue that should be possible. But we have not done, to be frank, we have not done any deal what is through a clubbing or an ESOP trust. But in case of a ESOP trust, we can definitely do it through the trust. But otherwise, any unincorporated, just a forum of employees, I don't think that is workable.
Right. And Mr. Money also has raised a question, but then he had a discussion as well. But still, I would like to add, highlight the question as well, and maybe that has been answered, or maybe we can answer again on a specific point, right? Like what will be the rules and condition precedent to funding, and what will be the ease of funding in its right? So I hope during this discussion, Mr. Mani sir, it has been answered in one or the other way. But still, I would request your feedbacks and suggestions as well in this, like what are your feelings from a point of view from the finance world, and as we are seeing this, like from this finance fraternity as well, right? People have ESOPs now. Off late, people have started valuing ESOPs as well, right? They know, okay, I'm holding 10 lakh, I'm holding 50 lakh worth of ESOPs. And now other than finance people, like tech people, sales people, and other function people are also valuing it equivalently. Like earlier it was only the finance game, right? Maybe 10 years back. But how you have seen this change in the mindset and the behavior of the employees as well, and now people are coming upfront. Even some companies do not have a ESOP policy, some companies do not have a ESOPs in place, but some CXO people is hiring, some new employees are hiring. They are asking upfront on the interview and to the TA people, like what about the ESOPs? And we are seeing from advisory point of view as well, like many of the listed and old age company and the conventional companies are coming on the meetings or on a demo day, and they're asking like, no, we are having business from last 40 year, 50 year, but people have started joining in off late from the last 2 3 years, where everyone is asking about it, right? So with facilities like this, wherein employees will be provided with this new resource of ease of financing, right? Do What are your thoughts in it? Like whether it will give a push to the organization as well as to the employees to start valuing more to ESOPs and ESOP related wealth.
So question is to me, is it? Or Mr. Prasad?
I was asking it to you,
Okay,
Mr.
sorry,
Mani.
because I generally was thinking Mr. Prasad. So, first of all, thanks. I think this is a fantastic initiative. Yeah, I think see, listed or unlisted is one paradigm, is one issue, more to do with uh, the market determined value for a share versus a privately decided or a private entity or a VC or a company declared value for its share. So that is to me the big difference between unlisted and listed share more than anything else. So if I have, as an employee, if I have confidence that the company, let's say I'm joining your company, Manish, and you're offering me share, if I have reasonable confidence to believe that your price that you are taking for a share, you may issue it to me at one-tenth of that as an exercise price, that's another issue. But if I tend to believe that the price you're quoting is a fair value of the company, regardless of whether it's listed or unlisted, I should still uh, be more than happy to get a fair share of equity of a company that I'm joining in a fairly senior role, right? So that is from an employee expectation point of view. The point of ESOP funding helps, as you rightly said, around the time I joined, and then deciding the exercise point, time in which you exercise. Because the tax liability falls on the recipient and the time of exercise. And when I used to get ESOPs in listed companies earlier, I never cared a damn because I know I will exercise it. Tomorrow morning, I'll go to the stock market and sell it. Right. But when it comes to private, I guess that is a problem. So I think ESOP funding will definitely address the problem of arranging the money by an employee to pay taxes and the difference between the merchant banker declared value on that day minus the exercise price into tax rate. So if it is 1 crore and my exercise value is 10 lakhs, on 90 lakhs, if I have to pay 30%, it is 27 lakhs, right? Now, where do I get this 27 lakhs to pay? Because I don't know when I sell the equity. I may later on sell it at 5 crores, which is another issue. But how do I survive till then? So this 27 lakhs coming as ESOP funding will certainly benefit. I don't see that in any other way. But for certain allied questions that I, as a seeker, will ask is, what is interest rates? For how much time? Is there a tenor limitation? Because when Mr. Prasad said you don't have to pay anything till you actually liquidate. Now, that saying is one thing, but suppose I don't know. Is it 5 years? Is it 10 years? And what happened if there's no liquidation event in 3 years or 5 years? Then at some point of time, the NBFC will ask me, so is there a time limit? So these are some of the questions. One, the interest cost, and two, the tenor, which as the applicant, I would think of, you know. Other the rest of the thing is not their headache. It is my decision to take equity, and you as an employer are offering me price that you're declaring that NBFC has no say on that. It is between you and me, and how reasonably I believe that it's a fair price, and how reasonably you believe that it's a fair price to be giving so many shares to me. So that is arm's length between us. I think tenor and interest rate are the only two questions I will worry when I'm taking an ESOP funding.
Yes. You want me to answer it, Manish?
Yeah, I will
Okay,
say
sure.
thank you so much, Mr. Mani sir, for your thoughts and inputs on it. Right, and to be answering it, I don't think we have a very specific answer, but in general, like it depend, it will always depend on asset to asset, like whether I'm investing in Zomato, Paytm, Swiggy, or a very seed level startup right now. I will also keep in mind when IPO is in mind of the founders or not. Right, I will also evaluate. We will do our own homework as well, and based on that maybe our pricing, maybe the interest rate, maybe the benefits will come on table. It will certainly, it will relate to my the risk taking ability as well, right? If I am seeing, no, no, this is a Swiggy, hypothetically, right? I know it's a huge market, they will grow, maybe some now or then they will launch their IPO as well. I will be taking that call, and my cost will be linked to that only. But if it's a very early stage startup, I'll say, for example, our startup as well, right? We are at maybe at Series A or seed level, and IPO will be maybe 5 or 6 years down the line. So we will evaluate it basis my projections, my liquidation plan, and what maybe I am planning to primary or secondary or some acquisition or not. So it depends on those scenarios. So every organization to organization, these things will change, but not very differential will be there, like a cap or floor will be of a huge margins, but it will be up to certain a very nominal margin, or a premium or a discount will be there for basis of different assets.
Yeah, Mani, just let me just ask you the question of that specific on the costing side. So this loan will have three type of costing. One, there is a loan processing fee, which is a basic, usually maybe 2 to 4% type of a amount. Then there is a fixed interest, which again will vary between 12 to 14%. Then there is also a variable interest, which is linked to the fair market value of the underlying shares. See, because here one should understand the benefit is, one is there is no EMI, which is a very big point. And the non-recourse is a very important point. That means we are taking call on the company that for any reason, if the company is going under, we are taking the risk of that. Because of all this, there is a variable interest which is linked to the fair market value. But any incident in all these costs, it is not serviceable on a monthly basis. All these are payable only at the time of the liquidity event, which is the important point. And for in even if it is payable at that point in time, the tax arbitrage what you are going to get, the employee is going to benefit. The cost is definitely a part of that, correct? So even if the cost is payable, in principle, the employee is not paying the loan cost from his pocket. It is actually sharing whatever the tax arbitrage gain that person is making. Out of that, a small portion being shared with us as a cost of it. So that's the way one should look at it actually.
So
Yeah.
as a
I
closer,
wasn't aware of the non-recourse thing, honestly, because I joined a bit late. So that's obviously very very interesting
Yes,
point that you made. I wasn't aware of the recourse not being on the borrower. So that's a good point.
correct.
So
Yeah.
the variable interest is in case of any delay, you charge a variable. I mean, in case of non-fulfillment, you charge it, or you charge it to customer who's paying back the amount also when as and when due.
No, the
I
variable
mean, is that
interest is,
something like a
yeah. So the variable interest is linked to the underlying price. And it's over and above the fixed
okay,
interest. There is some
okay,
part of the gain what the employee is making. We are saying you are making an X amount of money. You just share a part of that with us, sort of.
got it, got it,
Because of the risk
okay,
associated is in a different level.
okay, got it.
And the
More
period
like an
again,
underwriting, more like an
exactly.
underwriting fee type.
Correct.
Okay, got it.
And again, the period is there is no fixed tenure to it. It is purely linked to the liquidity event, but the only thing in some time depends on the company credibility. We may put some condition that assume the IPO not happening in 3 years, 4 years, 5 years, then we will have a right to sell the shares of the underlying shares basically to enforce the security. That is the only condition. Otherwise, there is no upper time limit in that sense.
So just to before we close, we have the final
Yeah, Sani, you're there. Manish, you exit.
yeah, sorry.
Okay, sir. Yeah, you can conclude it. Yeah.
Yeah, sorry. I was just saying before we close, we have the final uh, query or answer, and then we'll wind up the session. Before that, I would thank you everyone for being patiently listening to us, being there from the minute one till right now. All the audiences who are there, who were there listening and sharing their thoughts and all. Thank you once again for keeping aligned with us and asking the queries. And we hope this was a wonderful session for you and you have invested your time well and got all the queries. Still, as a disclaimer and as an information, I'm saying every question asked during the chat or during the session will be answered one to one as well post the webinar. We will be sharing a detailed Q&As as well as the documentation of the webinar for your future references. Right. As a last question, Mr. Prasad, there was a query or a comment. Can you share some of the success stories from the employees world, like who has availed the financing facilities and then enjoyed the tax arbitrage, maybe from a noun organization, maybe from some people? Like I can definitely vouch it, but I will answer from. I'll have to from
Okay.
you.
No, see, because of the privacy reasons, I would not like to share the name of companies, but we already funded around 70, 80 employees who availed this loan, and definitely they have made the tax arbitrage benefit of it.
So thank you so much, sir, once again, and
Thank
we
you.
we will hope to see all the audience and the participants once again in the next round of the webinar, which is coming on the month of August, maybe post Independence Day. There's a long weekend; everyone will be on a long holidays. We'll be arranging on a very new topic. We hope everyone will be joining there as well. Once again, thank you so much, everyone, for joining in. We'll be sharing all the answers and questions post the
Thank you,
webinar
Manish.
with
And
you. Thank you, Mr.
yeah,
Prasad. Thank you,
thank you. Thank you
everyone,
very
for
much.
being there with us.